Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Unfortunately, Mr. Michael Becker is on another due diligence assignment, so we wish him a lot of luck looking at another property for his group over at SPI Advisory. So today we're going to feature JP CONKLIN with Pensford in the podcast. We recorded this discussion last week, March the 22nd, the day the Federal Reserve changed interest rates, with over 300 apartment investors at the Old Capital Speaker Series here in Dallas. JP walked through the future direction of interest rates after that 0.25% point hike last week. Again, the Speaker Series is an educational event and great place to network, and we bring in the top speakers in the apartment industry. JP is an expert in the direction of current and future interest rates and that effect it has on the apartment financing and your investor risk. So we really appreciate JP, who flew all the way from North Carolina. So thanks, JP. We started the Speakers Series event last week with a quick presentation of the state of the market. James Zhang and I spoke about what we're seeing today with apartment transactions, or the lack of apartment transactions because of the higher rates. So a couple of things that I thought I'd share with you. Some of the things I said at really just the beginning of the meeting was about 5 different things. So starting with one. So today it's been difficult for syndicators to raise LP equity. A lot of the $100,000 LP investors that have invested in the past are not investing today. So I love apartments and I love apartment investing, but I think we've been spoiled with unbelievable returns. And with these higher interest rates and the more challenging cash flow, I see a little breather to be in this market, at least right now. 2, private equity shops. Those are the ones that are trying to be opportunistic out there, maybe buying some distressed assets or lending you the money to help you through maybe the ability that you don't have enough cash to pay for an interest rate cap. Well, those folks are still out there and they'd love to lend you money. And but what price? 13, 15, 20% or more to let you borrow, $1 million or $2 million or $5 million to keep your deal going. So those opportunistic private equity shops are out there and looking for an opportunity. So 3, who's buying property these days? And I'm really seeing is a lot of the buyers are 1031 exchange buyers. And they're pretty much the only buyers that are buying out there. And I say that as a generalization, that when they sold something, they got to buy something. And so when they buy property, they're using from the sale proceeds of a property that they just sold. And so that's what I'm really seeing is the kind of the guarantee for a seller when you have a 1031 exchange buyer coming in that has to execute something, figure out what they're going to buy in 45 days and close in 180 days or sooner. So the exchange buyers are pretty much the only buyers that I'm seeing out there because it's becoming much more difficult for syndicators to raise that $100,000 equity checks with the limited partners. So number 4, I was in Miami Beach last week for a bankers meeting, a convention. So at the bankers meeting, you have a lot of bankers throughout the nation talking about our business. They talk about Fannie Mae and Freddie Mac loan products, interest rates, structuring deals, and of course, bridge lending. Here was the funny thing. I saw a bridge loan underwriter sitting all by himself, all alone. So, he was the decision maker for those non-recourse, higher leverage, adjustable rates, short-term transactions that had interest rate caps on them. So for the last 3 years, he's been the most popular person at these events. Like the pretty girl at the prom, everybody wanted to bend his ear and talk about a possible loan scenario. So he was very, very popular. Until this year, nobody was talking with him. He was all by himself. He was just staring at his phone, and no one came up to say hi. So I walked over. Of course, that's the way I am. I said, hello. I said, how's business? And he said, I needed a break. It was way, way too much. And it was. They were closing over $1 billion in bridge loans a month. $1 billion. They were major players in that market the last couple of years. Today, not so much. I think they laid off about 85% of their staff. seeing where interest rates are at and where they're going to go on these bridge loans that are tied to adjustable rates. But he did say to me, which I thought was interesting, is about where spreads are at. And if you know anything about trying to calculate interest rates, you have a spread, which is kind of the profit spread, over an index. The index is a thing that can change. The profit spread stays the same. So right now, spreads are about 485 over SOFR, 4.85 over SOFR. So if SOFR is about 5% right now, so 485 plus 5%. And so all-in rates are almost 10% for the bridge loans. So the window is still open a little bit, but not too many folks are engaging in bridge loans. Bridge loans today mostly are looking at, say, lower leverage, 55 or 60 or 65% leverage loans with Fannie and Freddie, and maybe doing a 5-year loan or a 7-year loan and going with maybe a shorter term of the loan and maybe doing a burn off of the yield maintenance on those type of loans. But those are probably the most popular two loans out there, the shorter term Fannie Mae and Freddie Mac loans. And number 5, and it's the last part to this discussion, was something that happened last week. So I have an off-market seller working with a local broker to find a buyer to purchase his property. So the property is not really listed for sale. So it hasn't been turned over. So there's not really a listing agreement. There has been no marketing done to the property, but the broker has done some quiet tours of the asset. The seller bought this property last year or beginning of last year or two and wanted a big price for somebody to buy the property. So the agent found a potential buyer, the buyer who has purchased over 2,000 apartment units in this local area for the last 8 years. And he owns his own property management company. So he's a smart guy. He knows how to run a deal. We walked the property and the buyer liked it. And we've done a lot of business with the buyer in the past. And, he's a pretty competent person. The buyer looked at the seller's financials because he knows how to run the property, not just theory, because a lot of people think that they know how to run the property, but he really knows about expenses and operations, and he created his own pro forma. Again, if we were to give him the keys to the property, how are you going to run the property for the next 2-3 years? Show it to me in like an Excel report, and that's really my pro forma. Show me the income that you're going to be able to generate. Is it going to go up? How much is it going to go up by? What are my operating expenses? What's that going to look like? And with the step up of property taxes and what insurance is these days, what's the NOI going to be? So he submitted that to us. We, the lender, reviewed it. We shared it with our bridge underwriter just to confirm and make sure that how we were looking at it was correct. And it was giving us, based on his pro forma, a much lower loan amount. And in turn, he couldn't get to that higher sales price that the seller needed. The way the buyer looked at it was reality and how he would actually run the property with knowing real operating expenses and normalizing rental growth. But here's the funny part. When the buyer submitted that in, the broker said, hey, listen, that amount is not going to work. We're not going to be able to do a deal. And so the seller said, hey, listen, I want that higher price. And then he came to me and said, hey, Paul, can you submit my pro forma to the bridge underwriter to get the larger loan dollars? He said, use my numbers, my pro forma. Don't use the buyer's numbers to get the higher, because you're not going to get the higher loan dollars. I just laughed to myself. He was telling me that to get the higher loan amount, I got to use, to get to his higher sales price, don't use the experienced buyer's numbers, use my numbers. My numbers work for the sales price. Told that to the buyer. He just had a chuckle out of that. So my advice is make sure that you review your pro forma, your underwriting numbers with your property manager and your lender, and make sure that you don't go down a possible rabbit hole. So let's get to the JP. So JP did a great presentation in front of, again, 300 apartment investors here in the DFW area. Again, to be part of next month's speaker series in Dallas, we need for you to RSVP to the oldcapitalpodcast.com website. Again, RSVP to the oldcapitalpodcast.website to sign up, because next month we're focusing on property management with 3 of the top property management companies in the Dallas-Fort Worth area. And the property manager, as you can imagine, is the one that can make or break your profitability. So you want to listen to what they're going to share with you, some inside secrets about how they're running property these days, what they're seeing about how these properties need to be run, maybe some rules about what's going on within some of the towns or cities that you don't know, that you need to know, and how they're looking at evictions and how things are going within the property management industry itself, maybe with updated software and maybe with some virtual employees about how to continue to stay in touch with your tenants. So we look forward to having you come join us. here in April. So again, we'll see you next month. Make sure you RSVP to the Old Capital Speaker Series, and let's get listening to JP Conklin.
You guys shouldn't be too mad at me. Cowboys finally won a playoff game. Congratulations. Very proud of you guys. Hang in there. Yeah, thanks for scheduling me on one of the most volatile days of the history of the markets. Good timing. So not everybody sits around and watches J. Powell conferences like I do. So I would basically sum up today's statement as essentially, this is fine. He just spent a lot of energy trying to reassure us that the banking industry is totally fine. Nothing to see here. I had a lot of flashbacks to 2007 and 2008 when I was at Wachovia. I was on the trading desk and I ran interest rate derivatives for the West Coast. And I distinctly remember Bear Stearns hedge fund going under summer 07. Which was like a year and a half before anybody else really felt the pain, right? But our traders told us, hey, a credit crisis is the worst kind of crisis. This is a big deal, right? CMBS totally froze up, but not much else changed. We just felt like everything's slowing down. Things were going south. Springtime 08, Bear Stearns, the firm, goes under. And we're like, uh-oh, this is weird, right? Like a bank just failed, right? Sound familiar? Fed kept saying everything's fine. It's isolated. We've got this under control. I look back on that. Bear Stearns needed $25 billion to be bailed out. It feels like a quaint number these days. Just $25 billion. Just cut them a check, whatever, like, right? But at the time, there was still this concept of like, and fear of moral hazard. If we bail them out, who's the next, right? We can't do that. We got to send a message. Probably sometime mid-September 08. It was a Monday. I talked to one of my best friends who ran all of trading for Wachovia interest rate team. And I said, because our stock had come down. It was like $42 a share, $29 a share. And I was like, how bad is it? We had replaced the CEO a few months prior, but we replaced it with a guy who was connected at Goldman. And he was connected with the Treasury. And so we thought, okay, there's definitely some stuff going on behind the scenes. We're going to be okay. And I said, how bad is it? And he said, we will be out of business by this weekend. And I thought he was messing with me. So I'm like, yeah, right. No, seriously. And he's like, we can't trade with anybody. No one will trade with us. We have no ability to hedge any of our risk right now whatsoever. The entire bank is fluctuating at the whims of the market, and we have no ability to manage this risk anymore. He said, we'll be out of business by this weekend. He was wrong. We made it till Saturday morning. Friday, there was a run on the bank. Saturday, that run continued. Anybody who had deposits at Wachovia took them out. Anybody who had an undrawn line drew on it and deposited somewhere else. We were out of business Saturday morning. Sunday, we got sold to Citi for $1 a share, which was like the blind leading the blind. They were just as bad a shape as we were. The Fed came in and was like, no, we can't allow that. They're terrible. We're going to have to bail both of you out. Here's Wells. Go talk to Wells. We got sold for $10 a share. Monday, woke up a Wells Fargo employee. It happened just that fast. And so when SVB started happening, I'd send a Slack to my team because on Wednesday night is really what kicked it off. They had to come out and they had to raise $2 billion, right? Again, a quaint number in the grand scheme of things, not a big number. They had to raise $2 billion. But it caused everybody in the market to say, why? Why are you suddenly having to raise money right now? And they started digging in a little bit and they realized, wait a minute, you guys bought all these treasuries, 10-year treasuries, when the yield was 1.5% and you're upside down on them. You've lost a lot of money on those bond holdings. Up until this point, SVB had not had to recognize those losses because you're allowed to carry it forward as a mark-to-market loss, right? So it's just, yes, it's supposed to be worth 100. It's only worth 80, but I haven't actually sold it, so I haven't recognized the loss. Might see some parallels with real estate. I don't know. It's not my job to tell anybody that. But it starts ringing true about like what's going on that we haven't actually recognized yet. They go to raise the $2 billion. Everybody pulls back and says no. And not only are we not going to give you $2 billion, we're going to start investigating this. We're going to start looking at the math here. And the market started running the math on SVB. Turned out they were upside down. They were negative equity if they were forced to sell their treasury holdings. Now, they weren't at that moment. They didn't have to sell all of them, right? They were going to lose a couple $1 billion. It wasn't the end of the world, but the market didn't care. The market said, but if you had to, you would be upside down. You would cease to exist as a bank. So I sent a message out to my team and said, I've seen this play before. Yesterday, the stock price went from 268 to 106 in a couple hours, right? Halted trading several times. Then the run on the bank started. Because all their friends who had made them rich over the years, the VCs and the Ps who were artificially propping up the value of the tech companies, said, you know what? You guys should probably take your money out of that bank. Because if they go under, you're going to lose those deposits. FDIC is only up to 250 grand. So guess what everybody did? They ran and took their money out. That exacerbated the problem. That took me right back to the Wachovia days, right? I was like, that's when we ceased to exist in just a matter of hours. We went under just that quick. They had, I think it was $42 billion in deposits withdrawn on Thursday. Friday morning, I sent that Slack out and I said, they'll probably get to the other side of this, but there is some non-zero chance that they don't survive this, and they cease to be a bank by Monday. 4 hours later, they were seized. They stopped existing as a bank, right? And so what I would suggest to people is when it comes to the banking industry, it can happen very fast to the first few players, just like it happened to Bear Stearns. Keep in mind, just because Powell is trying to reassure us today everything's fine doesn't mean it is. It took 18 months from the first Bear Stearns hedge fund going under till the rest of the banking industry collapsed. So I do not buy the story that everything is fine today. I think it could be fine. 2 weeks in is too early to say it is fine. And so be mindful of that. And I worry personally in the commercial real estate industry is what happens to lending appetite that felt like it was finally starting to thaw a little bit. Do they all pull back again? Do they suddenly take that defensive posture again just as they were starting to come out? And they're like, nope, we got to pull back, right? Now we'll see. Brokers who are the eternal optimists assure me, no, all these banks are going to be lending aggressively. We're good to go. But we'll see if they actually deliver a closing. I'm not convinced that in 2 weeks, the news got passed down from the top of the house to the individual banker. We are no longer in the lending business right now. It is time for us to take a defensive posture. Let's get on the other side of this. Give it a couple months. Let's see what happens. But until then, just because J Money says this is fine doesn't tell me it is fine. Okay? Be aware of that as you're considering your financing options. Be aware of that as you're considering the selling options. That there is something out there totally outside of your control that could get worse over the next sort of 6 to 12 months. I personally don't believe this is a replay of 2008 because banks are so much better capitalized than they were back then. 2008 was a house of cards. I was at Wachovia. Our CMBS guy was doing 100% LTV deals, non-recourse at like swaps plus 85, 90 basis points, right? It was insanity. Banks are still way more conservative now. And the regulations did a good job, especially the larger banks, of protecting them, right? So they are well capitalized. I don't see a total implosion. Doesn't mean we can't have a cooling off, and doesn't mean that there aren't some smaller banks who don't play by the same regs who aren't going to be exposed in the coming months, right? So with that silver lining, let's talk about today's meeting. Oh, you're already quitting, huh? That was all it took? You're just like, you're like, I didn't invite this guy. Don't blame me. I'm getting out of here. All righty, so hike today, 25 basis points, okay? 2 weeks ago, the market was pretty certain it was going to be 50 basis points. Today ended up being 25 basis points. The market had said it was like an 85% chance of 25. I thought it was more like 50-50. Normally, when the market and the Fed disagree, the Fed will come out and massage the statements. They'll send signals. But when you get within a week of a Fed meeting, they're not allowed to say anything. So they had no ability to massage the message. So I actually thought it was like a coin toss. I did think it would be 25 basis points, but for different reasons. Mostly, my thought was, if they pause, the market might say, you know what? Does that mean all that massive intervention you just undertook wasn't enough? What do you guys know behind the scenes that we don't know? How much worse is it going to be? And he was almost forced to hike 25 basis points just so he could tell everybody it's fine. It's tough to say everything's fine if I'm also pausing, right? I also think he wanted to expend a lot of energy convincing everybody there are two different things that we are tackling right now as an FOMC. Number one is financial stability. And that's got nothing to do with hiking or cutting interest rates. That financial stability is around quantitative tightening and quantitative easing, the size of the balance sheet, okay? So you guys might have heard that the Fed's balance sheet ballooned to $9 trillion, right? It got up to $4.5 trillion post-financial crisis. Then after COVID, it went up to $9 trillion. It's crazy, right? And there's no way we're ever getting back down to zero. I see no scenario where we can get back down to zero. Every time the Fed shrinks the balance sheet by about $700 billion, everything seizes up and everything breaks. And that's what we're seeing right now. So I think what he's trying to convince everybody is that tool is related to financial stability. That's got nothing to do with me hiking rates today. Hiking rates is related to controlling inflation. And we still have some work to do on controlling inflation. I was surprised. I thought he was a little bit more dovish than I expected. Because one of the things that he said, and this was totally unseen. I did not know that he was going to say this. There's no whispers about this. He spent a lot of time talking about how credit conditions were going to tighten. And that took me back to my Wachovia experiment and like, what is he signaling to us right now that's going on in the banking industry? Are they going to get even that much more tight with lending standards than they have been? Because he said repeatedly over and over again, credit conditions are going to tighten. We haven't seen it yet show up in the indices that we track. It's going to happen. And it was like a signal that that's going to substitute for other rate hikes. We can stop now because that's going to do the rest of the work for us, right? Which I actually interpret as a pretty reasonable conclusion from the Fed chair because they're normally doing backward-looking stuff. This is at least acknowledging things are going to tighten up. These regional banks are going to tighten up. It's going to slow things down. It's happening. And that means that will replace 1 or 2 or 3 hikes, right? And allow us to sort of grind slower into this soft landing that they're hoping to achieve, which I think is totally out of question. May 3rd is about a 45% chance of a hike. I think that is still maybe a little bit high. I think today might have been the last hike. The reason he couldn't pause today was because the Fed has no track record of pausing and then starting again. So even if he came out and said, you know what, guys, financial instability, banking crisis, we don't want to pile on, so we're just going to press pause today, May 3rd is definitely on the table. I think the market would have said, no way, you're full of it. It's never happened that way. I don't believe you this time. You're now on the clock for rate cuts. And so he's like trying to limp along at 25 basis points a pop as long as he can and just sort of stalling the pause because he knows once he pauses, they're on the clock for the cuts, right? And he doesn't want that yet because it could bring back expectations for inflation to go back up. And it could ease financial conditions. It actually makes everybody's life a little bit easier when they finally pause, right? He doesn't want that yet. He still wants to be applying the brakes. And he's not able to do that if everybody's thinking about how rates are going to be slash and burn in the second half of the year. Notice that the first cut is being priced in June. So the market's saying there's still a pretty good chance that they're going to hike again on May 3rd, but then they're actually going to start cutting on June. And I think that's too early, but that just gives you an idea of how the market is interpreting this, that you should have stopped. You're going to keep hiking. You're going to slash and burn on the backside of this. It's just like every other cycle we've ever seen with you guys. That number is a little stale there. Post FOMC, now the market's got Fed funds 4% at year end, 3% at year end 2024. So one way or another, we're getting closer to the point where they start cutting interest rates. So when we track volatility and interest rates, we don't track the VIX, which is what a lot of people track. That's equities. We track the MOVE index, which is interest rate volatility. And as you can see, SVB was the second most volatile period on record. Only other time was Lehman going under, right? It was insanity last week. So last Tuesday, 2-year Treasury was down 100 basis points in a couple days. And so my thought was cap prices are going to be way down. We need to call all these banks that we buy caps from and figure out where their pricing is. And then we need to call every client who has a cap that they might need to buy this year and at least put it in front of them to say, prices have fallen by half. Here's the number if you want to move forward, right? The first bank that picked up the phone said, actually, our price is higher than it was a week ago. And I said, that can't be true. Rates are down 100 basis points. And they said, sorry, volatility's up. It's out of control. It's higher. I said, to heck with you. I didn't say that. I said something else, but I hung up. It's like if I was at an Eagles game, right, and playing the Cowboys. You guys could probably picture it, right? So I hung up and I said, to heck with you. I'm calling the next guy. Called the next guy. Same thing. Hang up. Called the next guy. He said, we're not selling caps today. We're out of the cap business today. We won't sell anybody a cap. I won't give you a number. We found a couple more banks like that. We found 2 banks that would transact last Tuesday, only 2, SMBC and Wells Fargo. And both of them self-insured. They were not able to hedge themselves in the market. And so they just charged a fortune and figured I'll self-insure until markets calm down a little bit. Then I'll go hedge myself at that point because I've charged you guys so much that I'm comfortable I'll be able to protect myself. They're the only 2 banks that would quote last week. By Friday, it had returned a little bit to normal. We could still get numbers. The numbers are terrible. They're way too high relative to where rates are and where expectations are. But at least you can get one if you have to. So imagine you've got a Freddie cap maturing. You have to buy one. You can get one. Last Tuesday, that was kind of in question. So this discount window, just in case anybody doesn't follow this as closely as I do, a discount window is basically when you go to, if you're a bank, you can go to the Fed and you can borrow money. Okay? They try to avoid this because it's a signal that they have some kind of weakness. So they really try to avoid doing it. That's why you can see it's usually 0, right? Banks avoid this because it's a signal to the market that something's wrong with them. So they avoid this. If you go back to the financial crisis, Wells Fargo was actually forced by the Fed to borrow from this window to lay cover fire for the other banks so that nobody stuck out like a sore thumb. And Wells argued and said, I don't want to borrow. And the Fed said, too bad, you will be borrowing $25 billion from us, one way or another. Go park it somewhere, but you're taking the money because I need you to help cover for the other guys who actually need it, right? So most of the time, nothing happens. They open up this window. And what they said was banks like SVB, your treasury holdings, your MBS holdings, those values that have dropped from $100 to $75 or $80, instead of being forced to sell and recognize those losses, post them as collateral to us, and I'll give you cash for the par amount of the bond. Not what it's worth today, not the $80. I'll give you $100. Okay? That way you don't have to sell it. You just give it to me and I'll give you back cash. You now have liquidity, right? Single biggest draw ever on record, more than the financial crisis, happened last week. That's why I'm like, I don't know that this is nothing. This makes me nervous. The next number comes out tomorrow. If that number plunges, that's a good sign. It's like, hey, okay, maybe this is okay. Maybe banks are just doing it out of precautionary measure and we're going to be okay. If that number is still up there or higher, it tells me something's up. These banks have something going on behind the scenes, and they're borrowing from the Fed as fast as they can. And that's a liquidity issue, okay? So tomorrow afternoon, we usually get the numbers. It'll be interesting to see what this comes out at. More than 2008. Think about that for a moment. This is not nothing, okay? And the other thing I like to point out to people is I've never seen a market reaction as violent as this one that turned out to be nothing. I can't remember a time when the market puked like this for 2 or 3 weeks, banks started failing, and a couple months later we're like, oh, you know what? We kind of overreacted on that one. That's our bad. Sorry about that, guys. Everything's fine. Sorry. Totally overdid it. It doesn't work that way. No real good leading indicator here that this was going to be an issue. Here's the Fed's own stress index for banks. Everything's fine. Nothing to see here, right? If you go back to 2008, you could at least see some pressure ahead of time. This time around, nothing, right? Meanwhile, they totally dropped the ball when they're regulating these guys. They knew everything that was going on. Auditors had just signed off on SVB something like 10 days prior, right? Like, what is going on here? Feels very reminiscent to me of 2008. I met with another company yesterday, and they said this guy had actually written a paper about the S&L crisis of the late 80s, which I don't really know anything about. You guys might, because that was the last time the Cowboys were good. But that's how you got through the late 80s, right? But he thought there was more parallels with the S&L crisis than with the financial crisis of 2008, right? And so it's just something to keep in mind. But it's not good news. It's not nothing. Before all this happened, recession odds were surging pretty dramatically. Right, we're up over 50, 60% by most measures. That's usually the threshold needed to trigger a recession. You don't need to get to 100%. That happens after they've already declared it. This is more like a leading indicator. Once you hit 50%, it kind of means it's going to happen. So one of my biggest frustrations with the current Fed is they keep relying on these backward-looking things to make policy decisions about what's going to happen going forward. This leading indicator index is really, really good at predicting recessions, and it is deeply negative right now. it suggests very strongly there will be a recession. And this is using things that the market agrees are forward-looking rather than backward-looking, right? So you can see over there on the far right, it's dropped. This is pre-SVB. This is not because the banking crisis. That's going to just exacerbate that. It was happening anyway. The other big signal is the inverted yield curve. So I talked to you guys about this last year. Anytime the yield curve inverts, we have a recession. You can have a recession without an inversion, but when you have an inversion, we've never not had a recession, ever. And so what that means is long-term rates are below short-term rates. 10-year Treasury is below the 2-year Treasury. And what that means is the market thinks rates are going to be crashing shortly, right? That the 10-year Treasury at 3 or 3.5 is going to feel awesome a couple years from now when rates are back at 0, okay? So what you can see there is it doesn't do a great job of leading it with any certain amount of certainty around time. Kind of the average is sort of 18-ish months. It inverted April 1 of last year, so we're coming up on the 1-year mark. And you hear a lot of economists talk about sort of the fall is when a recession. That would be around 18 months, right? It kind of ties out. The steepness of the inversion is as deep as it's been in 40 years. There's really no good correlation between the steepness of the inversion and the subsequent recession that happens afterward, okay? Where there is a good correlation is how long are we inverted? And Wells did a great piece on this last year. And what they found was if you've been inverted for more than a year, the recession that follows is worse than normal. April 1, right? Like it's right around the corner. So this would tell us it's coming. This is going to be painful when we get there. I've got a lot of meetings the last couple of days, and I've met with a lot of people like, let's just kind of get it over with. I'd rather just break everything right now and start over than for this to drag on for another 12 months, right? And this sort of banking crisis, the cracks that we're seeing in the system might actually end up doing that. This tells me high likelihood that we're going to have a recession. Any hopes of a soft landing, I think, are gone. Sometimes people say, well, did it predict COVID? Curve actually inverted prior to COVID. Sometimes we forget that the Fed was cutting rates prior to COVID. Right? We were already actually heading for a recession prior to COVID. It's like, no, obviously it can't predict a pandemic. It didn't predict this banking crisis. What an inverted curve tells you is the market believes the financial system is so strained, it can't withstand a shock. The shock this time is just higher interest rates, right? Before it's been COVID, before that it's been a financial crisis. There are different shocks to the system. It just says we're not going to be able to withstand it, whatever it ends up being. Real rates. So this is one of my big misses from a year ago. I think I probably talked to you guys about this last year. It was March of last year. I'm doing a ULI capital markets symposium, and it's me and the Charlotte Fed economist on a panel, and we're kind of going back and forth. And I was skeptical that the Fed could hike rates 3% in 1 year. I was like, I don't think that they're going to apply the brakes that hard in 1 year. They've only done 3% once or twice in history. That's not their MO. And he said, here's what I think you're missing. Until real rates are positive, we don't believe that we're applying the brakes because we still have negative rates, which is still very accommodative. And when you hear the word real, when you're talking about real rates, it just means adjusted for inflation. Take the number that you're reading in the Wall Street Journal minus wherever inflation is equals real rates. So using a pretty simple example, Fed funds was at 4.7. Core PCE was at 4.7. Real rates were at 0. It's basically free to borrow, right? For the last year, it's been negative. Even though they've been hiking tremendously, it's been negative. From the Fed's perspective, that means they have not yet begun applying the brakes. That was what he was saying to me. And so he kind of popped me in the nose on that, and I was like, holy cow, they're going to hike more than I realize, because we are really far away from positive real rates. Now, Powell won't put a number on it, but sort of taking what we think he's implying is somewhere between 1 and 1.5% real rates is what he wants. That's him applying the brakes, okay? So very simplistically at the bottom, what I did was say, okay, give me what the Fed is projecting at year end, 3.5%. That's what they think core PCE is going to be at year end, 3.5%. Add 1.5 onto that. I want 1.5% real rates. What do I get? 5%. Where are we today? 5%. Where do they talk about pausing? 5%. Right? It's a very simplistic calculation, but it gives you a sense of how they're managing this right now. This 1.5% is them applying the brakes. If it's negative, They're still stepping on the gas. As you stretch out to the next couple of years and they predict inflation will come down, it implies they'll be able to cut rates and still maintain that 1.5% number. Now, if we have a banking crisis, all bets are off. This will get thrown out. But if we're strictly focused on inflation, you tell me where inflation is going to be at the end of 2024, I can give you a really good sense of where Fed funds will probably be, right? So here's my favorite graph, financial conditions. All the Fed actions are the inputs. This is the output. This is what the Fed uses. They use this. Powell references it in every conference, press conference he does. Gray horizontal dash line is kind of considered the Mendoza line. Anything below that is them pressing the gas pedal. Anything above that is them applying the brakes, right? And then the yellow line is kind of the recession line. So as you can see there, 2022, we were the most accommodative ever. And I would love to take a lot of credit for, Pensford having its best year ever in 2022. But it wasn't me, right? I had insane tailwinds at our backs, right? They start hiking, and this is what that Fed economist was telling me. We're not on the brakes yet. Until we get above that gray line, we have not touched the brakes. We're just letting off the gas. And so from the Fed's perspective, they have just now started to get into pressing the brakes. Okay, now the banking system's starting to collapse, puts all that into question. But from their perspective, this is really important. They want to actually keep applying the brakes to make sure that they bring down inflation. And that was one thing I was really missing a year ago, was that's their mentality. All of that run up and things were getting tighter and tighter is not applying the brakes. It's letting off the gas pedal, and that's different. If they're doing a great job of anything, it's winning the war on expectations. And inflation expectations are probably the thing that Powell is most concerned about, probably more so than actual inflation data that keeps coming out. Expectations are what lead to inflation becoming entrenched. If we all believe inflation is going to keep falling over the next couple of years, it's not becoming entrenched, it's not becoming part of our psychology, and they're winning that war, and they can eventually start cutting interest rates. If we all start believing inflation is going to be at 6% forever for the rest of our lives, now they're losing the war on inflation. So part of the reason I think he had to hike today was say, I can't yet allow that to start creeping back up. If I let off too soon, rates just now getting positive, that might start creeping back up. Look how much ground he has gained since the first hike. That's the peak, is that first hike. And it's come down to 4%, right? He doesn't want to give up that ground. That's been hard-fought ground over the last year. He doesn't want to throw in the towel yet. If we have a banking crisis, that's probably going to collapse because everyone's going to feel terrible about everything. He won't have to worry about managing this anymore. Absent that, he still has to send signals. He's focused on inflation. He even said at some point today on the press conference, we will keep hiking more than you guys think if we need to, right? Barring a total collapse, we're going to keep hiking if we have to. Today was the first signals he sent that he actually thinks that inflation is coming under control. The actual inflation has been a little bit more stubborn than he would have liked. Now, CPI is actually improved quite a bit. And I feel like that this improvement maybe doesn't get enough play in the media. June of last year was 9.1. That was the peak, right? We just got 6% 2 weeks ago. So in 9 months, we improved from 9.1 to 6. It's not where we want it to be. It's not the worst improvement in the world either, right? Core PCE, however, which is what the Fed likes to use, strips out things like oil. Saw oil finish today below $70 a barrel, right? A lot of CPI dropping is oil. If you take that out and say, yeah, I'm not going to give you benefit of that, let me look at other stuff. Let me look at services. It's not quite so rosy. And so this is the thing that's probably keeping him up at night right now, because he's like, it is really stubborn. They're forecasting that core PCE is going to fall 1.2% between now and year end. And it has fallen 0.8% in the last 12 months. That's a big change. I'm not sure that they're going to be able to pull that off. If that ends up being stubborn, they'll keep hiking. I think that's what he's looking at right now. He thinks it's coming down, and I would argue whether we hike another 25 basis points or not is kind of irrelevant. What we should be really focused on now is time, giving it time, right? When he hiked a year ago, he said, this is going to take 12 to 18 months before it even shows up in the numbers. It's improved. It has come down. And I believe a lot of it's come down because supply chains have largely resolved themselves. Yes, there are still weird things out there like autos, but by and large, most supply chain measures are back to pre-COVID levels, right? Retailers are actually starting to stockpile inventory. It's actually, I think it's going to roll over pretty quickly. It's going to get ugly pretty quickly. But core PCE still has a little ways to go. And he's banking on this thing cooling off pretty quickly over the next 9 months. And if it doesn't, he's going to be boxed into a corner because people are going to be saying, what are you going to do about inflation? The other number that jumped out at me today, they're still calling for unemployment to climb to 4.5%. That's about a percent increase. It's just under 1.5 million Americans lose their job, right? We're still gaining 300,000 jobs at the last report. I'm not sure how we achieve that based on what they're currently predicting. But he's saying we're going to drive up unemployment. We're willing to tolerate a couple million Americans losing their job in order to get this under control because the price of this not working, getting under control, is worse than the cost of 1.5, 2 million Americans losing their job. Now, this graph is terrible for a room like this because you guys can't see any of this stuff, so I apologize. I'm sure you guys are sending out the slides. So what it's meant to reflect is the amount of excess savings that were ramped up post-COVID. That's what that starting point is. It's like there was no excess savings prior to COVID. COVID hits. Everybody starts staying at home. Helicopter money gets dropped on top of everybody. Nobody really spends their money, right? Way more savings than normal to the tune of $2.1 trillion was stored up in the economy, just waiting to be unleashed. And then it started getting spent. And there's a green line in here that's sort of the aggregate of all of this, and it's coming back down. We are just about down to the point where we have spent all the excess savings. And so when you look at this consumer spending, which is 2/3 of GDP, it suggests it's going to slow down pretty considerably over the course of this year. All this money has been spent, but guess what? People haven't changed their spending habits. They just started using credit card debt. And if you look at the credit card graphs, they're all surging. So people are still spending their money. They just haven't changed their spending habits. And now they switch to credit cards. And guess what? Interest rates are up way more than they were a year ago. And now all of a sudden they're paying way more on that. It's starting to feel like it's setting the stage for things to roll over pretty quickly this year. And I think what Powell was doing today was trying to acknowledge this could change a lot over the next 9 months. And we need to be mindful of that as the Fed. We can't just keep hiking 25 basis points based on backward-looking metrics. Again, another terrible graph for this setting, but what it shows is core PCE leading into a pause. So this is inflation leading into a pause. Core PCE right now is 4.7, okay? We went back at the last 10 cycles, going back to 1969. Core PCE inflation is not usually 2% when they pause. They pause before then and allow it to just keep coming down. So just because we haven't gotten there yet doesn't mean that they can't stop. The one caveat is the last 4 cycles, it's been below 3 before they paused. And we're at 4.7. 3 is a long way away. So this makes me a touch nervous that if they end up stopping and inflation doesn't come down, we could be dealing with persistent inflation. And that sets the stage for what they're trying to avoid is a repeat of the 70s, right? That's the situation they're trying to avoid is in the 70s, the Fed was not asleep at the wheel. Fed did a good job of hiking when inflation ramped up. The problem was they stopped too soon. When inflation came back down, first time, got back down to 3%, and they stopped because unemployment had surged. The second time around, got down to 5%, and they stopped. It took 20 years from the time it crossed 2% till the time it was back below 2%. Powell's trying to avoid that. If we aren't below 3 when they pause, it makes me a touch nervous that we're not going to see it keep going down. What happens if like the first 3 or 4% is the easiest and the last 2 or 3% is the most stubborn inflation, right? He's got to deal with all these dynamics on top of a potential banking crisis. The labor market is really becoming my pet peeve of this entire cycle because all I keep hearing about is how incredibly resilient the job market is. And first thing I would say is I'm not arguing that the job market is weak. I'm arguing it's not as strong as people are claiming it to be. There is really no precedent for us losing jobs month over month in the first year of a tightening cycle. That's not how it works. It takes a long time for that to happen. So up here, we've got this graph like, okay, first hike, first time we had a negative job print, on average 1.7 years, right? There's a couple oddballs in there that are really extensions of the late 70s, early 80s that I kind of don't count, but we put them in there just because people think we're monkeying with the data. But really, it's like that was just an extension of one long tightening cycle, right? He paused for, 6 months, started again, they had job losses pretty quickly. In general, it's more like 2 years. And in fact, what we found is you usually don't start losing jobs until after the Fed has started cutting. So imagine a scenario that feels totally realistic where we're actually gaining jobs all year. They start cutting at the end of the year. Job losses don't actually start showing up until next year. That would not be weird. That's actually how it's happened every other time. And yet we keep behaving as if it's weird that we haven't turned negative on jobs yet. On average, we're gaining 203,000 jobs the 6 months leading into a pause. Why are we suddenly this time expecting that we should have negative job prints leading into a pause? The one that really gets me is this JOLTS report. Been doing this for 20 years. Never heard anybody talk about a JOLTS report until 3 months ago. And all of a sudden the Fed's apparently using it to dictate monetary policy. So the JOLTS report is, how many job openings are there? I don't know if you guys have seen it. That's what the graph on the left is. And Powell keeps referencing it. He actually didn't bring it up today, thank God. But it's like there's 2 job openings for every unemployed American. Job market is insanely tight. It's like, yeah, but how hard is it to keep a job opening online right now? If you've ever put a job posting up online in the last couple of years, it's free. Like, it costs nothing. I probably have job openings I don't even remember putting up there, right? And they're counting that as if it's this job opening. Or, the last couple of years, it's been really hard to get somebody. So you leave it up there and just say, if I get somebody amazing walking through the door, I'm going to take them. Otherwise, I'm not putting any energy into this, right? It also doesn't measure the quality of the jobs. So the people at SVB who are going to lose their job, do they have 2 openings for every one of their positions? Or are we suggesting they can get a bartending job if they're looking for a career change, right? It doesn't say anything about the quality of the job. It just says there's a posting about it. I'm like, what's that got to do with Fed monetary policy? ZipRecruiter CEO 3 weeks ago came out with their earnings and said, we are seeing a sizable downshift in the labor market. The intensity of the job searches, people pulling these job postings. He said there's a, quote, sizable spike in job seeker activity. And he said on this earnings call that they are a leading indicator for the labor market. He said, I don't buy anything that I'm seeing in the labor data. I'm telling you behind the scenes, we see stuff before you guys do. It's bad. And it started shifting 3 to 6 months ago. Their stock price fell by 30% in a couple days, right? These are the guys who are in this business. Like, it is slowing down. And we don't need to be at 0 for it to be a recessionary signal. If we don't get 150,000 jobs in a month, it's a contraction, because that means it's not keeping pace with population growth. 150 is the Mendoza line for jobs, not 0, right? But it's not just ZipRecruiter. LinkedIn said same thing. When we look across all these different hirings by company size, it's plunged. Well, guess what? Bartender jobs probably not posting on LinkedIn. Most professional companies are posting on LinkedIn, and it's fallen off a cliff. Like, this is happening. I own a software company. We could not hire engineers to save our lives for the last couple of years. Last summer, it started thawing out, and now we have our pick of the litter. We lost on a young woman who had less than 6 weeks of experience out of college. She had gotten hired and immediately laid off. And we found her through a recruiter, and she was hoping for 80 grand a year. We had been searching for somebody for months. We had swung and missed for months. I said, and she crushed the interview. She crushed all the tests. I said, offer her 90. Let's just get her in. I think she's a superstar. They called us back a couple days later and said somebody hired her for 125. 6 weeks, not even 6, 4 weeks. She'd been out of school for 6 weeks. 4 of those were she was employed, right? And I said, we're out. We're not doing this anymore, right? We don't have that problem now. We have no problems lining up interviews with engineers. So I think that this is going to change dramatically over the course of this year. Well, here's what James is hoping for. When you hike rates 5% in a year, stuff breaks, right? Traditionally, once the Fed pauses, they're on the clock, and they are cutting rates within about 9 months on average. They had that one cycle where they held on for 14 months. Aside from that, you're looking at really 7 months or less. That's why the market's saying, you know what? If today was the last day, you're cutting before year end. If May's the last day, you're still probably cutting before year end, right? The other thing I'd point out is, look how sharp the drop is. It falls off a cliff. We don't have a good track record of cutting 50 basis points, 100 basis points, and stopping. That's not how it works. We overdo it on the way up, hang out, realize we broke everything, slash and burn, start cycle over again. It feels like we've done that again this time. And what I was hoping for, I think I probably said this last time when I was here, was I was hoping we would get to a point where they would level off, give it some time, and then back out 50 basis points, 75 basis points. It's the only successful soft landing they've ever had. On the far left there between 5.1 and 7.6, 94, 95. They got to a point, they backed out 75 basis points, and they let it run for a couple years. Then they started hiking again and broke. That's the only time they've ever had a soft landing. We're not going to be able to do that this time. Unless they suddenly, in the next couple of months, say, you know what, we're backing out 75 basis points and then letting it run its course and see what happens, we're going to probably see a slash and burn again. The day of the last hike, that's the y-axis, 0 over there. The day of the last hike, the dashed lines are, what does the market think rates are going to do? That's a forward curve on the day of the last hike. What does the market think rates are going to do? Basically, flat for the next 3 years. Whenever they pause, flat for the next 3 years. The solid lines are what actually ends up happening. Like clockwork, within about a year, the bottom falls out. They pause. Everybody thinks, you know what, this time's different. They're going to be able to keep rates at 5% this time for the next 3 years. They're going to really win the war on inflation. Something happens, the system breaks, the bottom falls out, and they're cutting pretty aggressively within the next 12 months. So I disagree with the market that the cuts are coming in June unless the banking crisis heats up. But I do think by year end or start of next year, they're cutting, and it will be the slash and burn variety. I don't think they'll be able to just like back out 50 basis points and reevaluate. Oh, this one's a fun one for me. So cap costs continue to go up. Whenever the volatility settles, it should be good news for caps. With rates being down 100 basis points or 75 basis points, it should be good news for caps once we get rid of the volatility. We are still to the left of that gray bar, which is the pause, right? There is some chance that was today. Once you get to the pause, within 3 months, the bottom falls out of cap prices. They drop 50%. And I suspect there's a lot of people in this room who have a cap, either extension coming up or replacement due. There is some chance that if you have a cap coming due in, let's say, the fall, that you will benefit from this falling off a cliff in the next 3 to 6 months. It's probably not today, but there is a window where this is going to happen. And it happens for 2 reasons. Number one is rate expectations. Once you pause, you're on the clock for the cuts. Rates are coming down, right? Well, if they're coming down, the cap doesn't cost as much, it's not going to provide as much protection. The other reason is volatility. Right now, traders are saying, yeah, I don't think we're getting to 6. A year ago, I didn't think we were getting to 5 or 4, right? I have to charge you something just in case we do get to 6, right? November 2021, Fed said we were not hiking at all. Now they've hiked 5% in 12 months. If you're a trader, how do you hedge that risk? How do you charge you guys for a cap? So they're like, you know what, I got to do it. I don't think it's going to happen, but I've been wrong the last 12 months, so I'm going to charge you something just in case. Once you get on the other side of that and they pause, it takes that off the table. 6% is not happening. Now we know they're done. They have finally leveled off. We can now say, I don't have to charge you for 6%. I have to charge you for 7%. And the cap cost comes way down, right? So at some point, these cap costs will plunge. It's just a matter of when do we pause and what happens after that. Same kind of thing with the 10-year Treasury. You can see that the market sort of is implying sort of 3.5% 10-year Treasury for the next couple of years, just like the forward curve. It's going to be flat. It ends up not being, the bottom falls out, right? So that historical average on the bottom there shows you 10-year Treasury is very likely going to end up at 2% or less at some point during the next downturn, right? I've been saying I think it would finish this year pre-SVB. It would finish this year closer to 3 than to 4. Because the market's going to start pricing that recession that I believe that the yield curve is telling us is coming, leading indicators are telling us is coming. Market traditionally underestimates how much rates are going to fall once we get on the other side of this. And I think the last thing, again, you won't be able to see any of this, but we spent a lot of energy with the Old Capital team trying to come up with potential alternatives to what you've got, right? So in this particular example, and this will be in the slides you guys see, is essentially, hey, I have a cap that's deeply in the money, and I've got huge escrows that are being set aside. Is there a way for me to refinance that, kind of press the reset button on that stuff, get a higher strike cap, unlock those escrows, unlock the current mark to market on my cap, kind of press the reset button on this financing? And so we spend a lot of time on stuff like this with the Old Capital team to say, hey, we're trying to give you guys alternatives out there because I know the cap escrows are killing people, right? Call them, right? They'll call us. We'll work together. We'll try to come up with some analysis that you guys can just make your own decisions. Like, I try not to make recommendations on stuff. I just try to show you the math. Say, here's the math for this particular thing. It's up to you to make the best decision for your business, okay?
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.